Welcome back to another episode of Not Financial Advice. My name is Sean. Today is Saturday, February 17th, 2024. And on today's video, we're going to be addressing the next market crash, which I can categorically assure you is coming with a near 100% statistical guarantee of certainty. So the bad news about that is that your investments may go down. The good news is that if you have a not stupid investment portfolio and the right, not only emotional resiliency, but the right mental framework and guardrails, you're going to end up making a lot of money. I'm going to explain all of this, break it down to you right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, so let's get into it. I'll ask you to like the video, subscribe to the channel. As we often do here at Not Financial Advice, you're able to see 100% of my investments, not only on green days, but also on red days like yesterday. Friday was. Yesterday, the market went down about 0.5%, around 0.5%. My portfolio was down 0.5. My portfolio has gained 13.2%. To the market's 10.3% gain. So over the last quarter, starting from today's date, I'm outperforming the market by a notable amount. And so that's the topic of today's video, is being prepared for the next market crash. And what's often said is that the longer you stay in a casino, the more likely it is that you will lose money. But the irrefutable fact, the truth of the matter is that the longer you stay in the market, the higher and higher chance it is that you will, in fact, make money. And so I'm going to show you this. I'm going to explain bear markets, what my experiences with them have been, and why you really don't have anything to fear if you prepare now, both mentally and emotionally. That's really all that you have to do. So let's jump into it. So I'm going to start this video off looking at an X post from some really smart guys over at The Compound on YouTube, led by Josh Brown of Rittenholtz Wealth Management. And so this is a post they did recently. And what he says here is fantastic. So the market doesn't reward you for reacting in comfortable ways. It rewards those who can endure discomfort or do the things that others simply cannot bring themselves to do. And so you will lose everything if you follow this somewhat satirical little graph here. So oftentimes, people will say buy low, sell high. What I say is buy low, buy at the middle, buy at the top, buy low again, and never sell anything. But what actually happens for a lot of retail investors is that the market goes up, everyone's talking about it in their friend group, they get really greedy and they buy something. And then, the whales have bought the rumor, they'll sell the news. The sell off begins, the retail investor becomes fearful and sells at a loss, and then repeats that cycle ad nauseum. So that is the only way that you will lose everything. And when I say that, it's 90% literal, 10% satirical. What I'm saying is that if you don't have the right mentality, education, mindset, and a reasonably competent portfolio, you will miss out on the magic of compound interest, which will take from you the opportunity to better your life through investing. So let's dig a little bit deeper. So when we're talking about investing in bear markets, market crashes, all that you need to know, and you need to know this not only intellectually, um, but in a very fanatical way. Not to be sacrilegious, but you need to understand it to be an irrefutable truth that if you invest in reasonably decent assets that are based in and primarily derive their revenue from reasonably reasonably well-structured societies, that if you make those investments as such over the long arc of history, stocks go up and to the right. And we can see that on the S&P 500 index, which is tracked back to 1984, here on Google at least. But we can see that while there are ups and downs at any given point. If you buy and hold for a long enough period, your money will move up and to the right. Buying routinely, so buying here and seeing your money go down, buying here again, going down, having your money buy here again, instead of having your money all put in here and then waiting to be here to get your money back. When you dollar cost average in, you're in the green somewhere around here. So I think that makes sense. I'm going to have you like the video, subscribe to the channel, and let's continue with this presentation. So my personal experience with bear markets and investing. So I would say that my official birthday as an investor is going to be April 1st, 2021. And this concluded the COVID recovery bull market and went all the way until December 31st of 2021. Now, we had a bear market in 2022. And so what does that mean and what does it look like? For all intents and purposes, that bear market started on December 31st of 2021, and its lowest point, or the lowest date, was right here, right around October 14th. So a drawdown of just under 25%. So, for all intents and purposes, my longest period of time as an investor from this point to this point, my longest time period was actually from December 31st until this is crazy, right? December 31st until December 23. So, a full 24 months where the market was essentially flat and down. This is where I've lived for 75% of my investing journey. But what I had was the faith that if you invest in a reasonable portfolio of smart funds or companies that predominantly do business um, in functional societies, that over the long arc of history, that stocks go up and to the right. And so I believed that. And so I didn't sell at the bottom. I bought as much as I could. I bought a lot when I first got started, and I bought a lot when my income increased. I wasn't able to buy as much here, but overall, I'm pretty happy. And so that takes us, into the actual terms, the definition of what is a bear market, what is a market crash. And so we're going to take a look here on this article that describes the difference. So a pullback, that's when the market goes down from 5% to 9%. So just for your information, this happens about 3 times a year. Not a big deal at all. Now, a correction, on the other hand, is a drawdown of 10% or more. This happens about every 1.5 years, depending on who you talk to. But bear markets, 20% more, 20% plus drawdown. I would say from 20% to about 50% would be a bear market. Anything from 50 to 90% would be a depression. A bear market happens about once every 7 years historically. Okay, and so these are the terms that we're defining. Now, I'm going to bring you over to this really important article from Ben Carlson, a CFA, also affiliated with Compound, who I referenced earlier. And we're going to do a read through. I've highlighted the most pertinent parts. So, how often do bear markets occur? For example, there have been perma bears predicting a massive financial crisis and stock market crash every single year since the great financial crisis of '08. But it doesn't make sense to spend 100% of your time preparing for something that might happen 5% of the time. So Ben goes on to write, plenty of pundits have, think that we should be setting ourselves up for a bear market right now. The stock market was up big in 2023. A handful of mega caps have produced most of the gains for the market. If those stocks tumble, the market could fall as well. I won't rule it out, and neither will I. Here's the thing, though. We've already experienced 2 separate bear markets this decade. The COVID crash, S&P fell 34%, 2022 bear market saw a drop of 25%. So that was 2 bear markets in the span of 3 years, which is pretty rare. If we had another bear market in 2024, that would be 3 in 5 years. Has that ever happened before? So here we're taking a look at historical bear markets and drawdowns since 1928. And so I'll draw your attention to this area from 1929 to 1940. And so Ben goes on to write. And so, depending on how far you look back on the data, be it from the end of World War II or the beginning of the 1920s, and bear market occurs between every 4 to 7 years. So, Ben goes on to write, we haven't seen a back to back to back bear market in a really long time, not since the aftermath of the Great Depression and World War II. So he goes on to conclude, of course, the only time this kind of thing happened was in that time period, and it was no wonder that the stock market saw crushing volatility back then with everything going on in the 20s, 30s, and 40s. Using history as a guide, you would have to assume the prospect of another bear market coming again in short order would be improbable. The counter to this market would be that cycles are happening faster and faster these days because of technology and the speed of information. Um, there's a fact that outlier events and things that have never happened in the market tend to happen more and more on a regular basis in the market. So that's sort of an ode to the black swan event of 2020. But this sort of gives us that framework that, a 5% dip happens about 3 times a year, a 10% correction happens about every year and a half, and between every 4 to 7 years, we'll have a 20% um, bear market. And so we've had two of them in really short order, and historically, it's very unlikely to happen again. But what do you need to do to be prepared for that from both a portfolio standpoint and an intellectual and emotional discipline standpoint? So I'm bringing you in here now to a particular sub portfolio I've never shared before. This is where the majority of my all-time high YOLO investment in Amazon occurred. And so what you can see here is that I had transferred a lot of funds from a different brokerage um, in May or so of 2021. And this particular portfolio is at a high of $9,600, November 22nd, 2021. So I got a little bit of a jump start on the bear market. And I went on to see my investments um, go down by 49%, down to $4,900. So in watching this, I suffered, which something which could be better described not as a bear market, but as a stock market crash, bordering on my own personal portfolio's Great Depression. And what I learned throughout this is my risk appetite, my tolerance for risk was about one or two orders of magnitude less than I thought it was. So I didn't sell, which was great. I continued to buy as much as I could stomach, which was hard, held my nose, reinvested dividends, things of that nature. But I went on to diversify and go with some different stocks because my risk tolerance wasn't all that. And so, as you can see here, there was a lot more buying that happened in 2022 during the bear market. And what do you know? That produced higher returns, right? And so, this is another portfolio, probably my single largest portfolio, where in 2022 and 2023, I bought a lot of names such as Williams Sonoma, Netflix, Google, Coinbase, Mexican Coke, Salesforce, Intel, Vanguard Healthcare, aerospace and defense, Apple, international blue chip dividends, financial ETFs, so on and so forth, just to try to diversify myself away from the unrealized short term pain from my Amazon investment. And so this is why we buy low, mid, high, low again, and never sell. And this is what I experienced. I lived through not only that 49% um, crash in a market in my own personal portfolio, but I also have had individual stocks, right, that have been even worse. Stocks that, times I've been in them have been down anywhere from a complete market crash to what was a literal Great Depression in my portfolio. And I just kept in mind that reasonably smart investments in somewhat stable countries over a long arc of time will go up into the right. And I had that intellectual and emotional fortitude to, at the very least, not sell. So Amazon down as much as 55%. Well, I had an interest in it. Smith and Wesson down as much as 72%. when I had an interest in it, a little bit closer to about 65 for me. I got in a little bit closer to here. But then lastly, True Leaf Cannabis, truly a 1929 Great Depression crash in one of my assets. I'm down something like 40% on this now, but I sat here and watched it go down almost 100% and didn't sell. And at this point, I'm doing pretty okay. My investments are looking really great. Kind of hard to track it because I started in the middle of 21, but where I lived at for the majority of my life was a market that was flat for 24 months. And so my performance, I believe, has matched the S&P 500. There have been times of underperformance and outperformance, but from as far as I can tell, I'm doing quite good, just as sort of an amateur investor. And so that's why I wanted to bring this presentation to you, so that when you see scary headlines and thumbnails like you did on my video, you don't get scared. You don't sell. You just understand that you invest in a reasonably intelligent portfolio appropriate for your time horizon and your risk tolerance, and that you understand that if you have some decent investments, you don't make stupid decisions and you don't panic. If you're invested in reasonably functional societies, investments do go up and right over the long arc of history. For me, it only took about 2 years, so that's not so bad. And so we'll leave this video out here on this really fantastical chart, the Dow Jones Industrial Average from 1896 to 2016. And it's entitled Human Innovation Always Trumps Fear. Know this, that stocks go up and to the right. And while they can go down, if you bought here in the Great Depression and then you bought here and then you bought here, your cost basis was here and you were in the green there instead of waiting from here to here. And so buy, hold, reinvest. Don't panic, be smart. Like and subscribe for more content like this. Again, my name's Sean. This is not financial advice. Thanks for tuning in, and I'll see you on the next one.